We've got other problems, of course. This is not a party political broadcast. I have no political affiliations, but we seem to have moved beyond the war on terror to the war on banks right now. And working for a bank, I feel it's my duty to stand up. It wasn't just our fault. There were other people involved. There were the governments. There were the central banks, apologies, many of whom were very, very sensible, but some of them weren't. Inflation targeting, I believe, actually had a role to play in part of the crisis that was developed. It's great if you can forecast inflation right, but then if you forget completely about what's happening to credit growth, about what's happening to the quality of credit growth as well, then you've got problems. And actually Alan Greenspan, I think, possibly took his eye off the ball a little bit on that. But right now we've got banks being scapegoated for all that's going wrong, and whilst we share part of the blame for what happened, I think it's also a little bit naive to think that we're going to get out of this quicker by having a great big attack on banks, by preventing them from doing the sorts of things they ought to be doing right now, which is recapitalizing, probably first, rather than just lending indiscriminately just to try and meet some sort of political agenda. So I'm not sure I'm entirely behind Paul Volcker and Barack Obama with their new plan. I'm not sure the size of banks necessarily matters. I think there are all sorts of things we need to look at. Regulation is clearly wrong, and the way the banks are set up probably needs to be looked at as well. But I think in its current form, the attack on the banking sector is probably another mild negative. If we're teetering on the edge, whether it's going to be 1 or 3, this is an unhelpful development. Now, in terms of trying to forecast the Fed, these are the 4 things we would be looking at. Growth, not just a return to trend growth. All we really want to see is the output gap stabilizing. In fact, all we want to see is something even vaguely close to trend. We don't need to see that output gap shrink. In terms of credit, it's even more vague. What do we want to see here? There are any number of things we could look at, but just some normalization of the credit process would be nice. Inflation, core inflation has to stop falling. That's the one we care about. That's the one that actually reflects what's happening in terms of the supply-demand dynamic within the economy. So it's core that we care about, and actually probably not the published core, but some of the slightly wackier cores, the things like the Dallas Fed publish, the trimmed mean measures, which are still falling and are actually below 1%, a measure typically associated with deflation. And then unemployment. We want the rate to start falling. Well, it looks as if it has, but we still have huge numbers of people, disaffected workers, 1.5 million of them, who aren't even in the labour force. When things genuinely start to look better, they'll come looking for jobs, and they won't find them, at least not immediately. So the unemployment rate probably hasn't peaked by at least that 1.5 million when they start coming back. So we're still at this very tentative area. And for what it's worth, we think that the Fed are going to start hiking rates around September this year, and maybe even a little bit quicker than a lot of people think. That initial tightening process getting us to a level still very accommodative, but probably still quite low, might happen a lot faster than the consensus is currently forecasting. Again, slightly non-consensus view and slightly inconsistent with our growth view. Don't care. What's going to happen to markets? Well, if we are going to get some tightening from the Fed, then we ought to expect there to be a sell-off in the bond yields in the bond market at some point. Exactly when that's going to happen is slightly harder to say. I guess the first clue will be when the Fed starts to remove the excess reserves held on its current account. That will basically say in 2 months' time and no more, we will see the first hike in, and it may not be the Federal Reserve Fed funds rate. It may be the rate paid on excess reserves held on the current account of the Federal Reserve, but rates of some description will start going up. So that will be when the race starts. And I think you ought to expect the most almighty flattening in the yield curve, bear flattening. The front end has so little tightening priced in. This could really be quite dramatic. I think just the positioning of the market could lead to some fairly astonishing moves there. In terms of the equity market, these are some charts from our esteemed equity strategists in London at ING, and the basic message from them is that markets are, not outrageously priced right now. They're sort of mid-value. The Eurozone markets look better value perhaps than the US markets, and that would probably seem right from my very simplistic approach to forecasting equity markets, which I don't really do professionally, but the way I do it is looking at things like, I talk about the sweet spot for the equity market, that nice period where growth is picking up, where inflation is still very low, and where central banks haven't started to tighten rates yet. Well, we're closer to the end of that sweet spot in the US than we are in the Eurozone. So we ought to expect there to be a little bit further room to run in equity markets in the Eurozone than, for example, in the US. But I wouldn't want to give you the impression that I think there's a whole lot more mileage in the equity markets at this stage. I think we're beginning to run out of room. There may be a little further to go, but by the same token, we might see the most almighty pullback, especially when I think the market begins to realise that the Fed and perhaps even the ECB might not be quite as slow to remove the emergency policy measures that they've got currently in place. Right, I've got onto the Eurozone, which is good. So I've got this far without being cut off. Things are looking better clearly here. If you look at things, leading indicators like the Purchasing Managers' Indices, they're clearly pointing up, and they're great correlators with things like GDP growth. There's a problem, though. Some of the other leading indicators, consumer confidence, it's also been picking up, at least until today. But where's the spending? Confidence is up, but no spending. So I've got a bit of a problem, really, with the Eurozone recovery. It looks as if it's still very much reliant on exports, and exports which may not actually continue to provide a particularly useful boost beyond the next couple of quarters or so. We've also got potentially a problem in terms of what's happening to the labour market in the Eurozone. There are differences within the Eurozone. In Germany, there were subsidies to jobs, which mean that in the upturn, we're unlikely to see a lot of job growth. In France, there hasn't been that. And actually, this is one of those occasions where that cyclical comparison I gave you earlier doesn't hold true. The French business cycle doesn't seem to support that every cycle you take longer and longer to replace jobs. So there could be completely varying events happening within the Eurozone. And I think this is, again, another occasion to remind ourselves that the Eurozone is far from a homogeneous area. For example, take your pick in terms of competitiveness. A slide here, which I won't really go into any great detail on. The blue line, Germany, has always kept its unit labour costs very much under control, perhaps at the expense of having a stronger domestic economy than it could have done. But it means that in the upturn, it's exporting to Asia, where other economies within the Eurozone aren't. And we've got Ireland, Spain and Greece as comparators here. The equivalent to what these countries would have to do to get back that competitiveness would be to effectively devalue their currencies, which they can't do as members of the Eurozone, or to experience very substantial nominal and real, probably, wage deflation over the next couple of years. And we get more divergence when we look at the markets. You could look at CDS spreads. Here we've got spreads over bund yields, and clearly you can see there's a wide difference here. The Eurozone is not a homogeneous area. The economy, the recovery will be different wherever you look. In terms of what's happening in Greece right now, all I want to say is what they're proposing to do has never been done, at least hasn't been done since 1970. It wouldn't be surprising if it ran into difficulties. I've put a picture of some people rioting here. That's one of my forecasts for this year. I like to step away from GDP and inflation occasionally. It's a little bit more fun. And I think riots, fiscal retrenchment, public sector cutbacks, a nice hot summer, especially fueled by some alcohol. In the UK, that's always been a great combination for riots. So that's one of my messages I'd like you to take away tonight, if none other. And in terms of currencies, what's going to happen to the euro? Well, it's interesting that over the last year or so, most of the money flowing into the Eurozone has been effectively hot money, money market type money. So perhaps not that surprising that we've seen the euro weaken as much as it has during this Greek phase of concern and anxiety over where the future is. We still think there's further for the euro to fall. We get this cyclical divergence happening with the US, tightening happening, and the recovery in the US happening more substantially this year as well, which we think will take it further. So 125 would be our year-end guess for euro-dollar here. And we'd have to say something about the dollar in this role. We're looking for stronger dollar. There is still an argument about what happens to the dollar as the reserve currency. And as some of the charts on this slide suggest, there is a sort of onward decline in the holdings of the dollar relative to other currencies. But we still think it's got a big place in the world. If you look at the bottom right chart and just think about the debt markets here, the US Treasury markets are still far more deep than anything, even in the Eurozone, especially when you consider that that blue bar there, the government securities, well, it's not Eurozone securities. There'll be Spanish securities and Greek securities and Italian securities and so forth. So